So this is part number 19. Now we look at the next step, which is trade execution. So this is just an illustration, just an example. Okay, we don't have past data to do comparative analysis. We can do technical and fundamental analysis to a certain extent. Still, that data is not uh, adequately available. But we can look at trade execution using a past chart example. Okay. So this is Sangvi movers, and this is old uh, chart data. As per the regulations, we have to look at old data. So that is why I'm using this particular chart example. Now, remember what is our process? First, we do filtering, then we do shortlisting. In shortlisting, we use technical criteria. What is the technical criteria for a weekly chart trading, positional trading? Well, we need the pivot point. In this case, this is a cup pattern. So this is already marked in. So this is already marked in MarketSmith. You can check the weekly chart. So it's a cup pattern, cup without the handle. Okay. So how to remove this? Just a second. I will press escape. Yeah, it's gone now. So I will remove this. Okay. So this is the cup pattern without the handle. Let us draw the pivot point, which is the high of this candle. So that is 140. So I will take the rectangle. So we'll draw the blue zone. Double click here. So this is 140. Then I will take my calculator and I will do go 5% above 140. So 140 multiplied by 1.05, that is 147. So this is 147. Okay, so that's the buying range. Okay, then we will draw the selling range. So we'll draw a line here. Okay, this will be 140 multiplied by 1.20, so 20% above the pivot point. 40 multiplied by 1.20, which is 168. And this will be 25% above the pivot point. So 140 multiplied by 1.25, 175. Style, the color will be green. Okay, so green, this is the selling range, 5% range. This is the buying range, 5% range, and then the stop loss. So let's draw another. So this will be 5% below the pivot points of 140 multiplied by 0.95. That's 133. And this will be 8% below the pivot point. So 140 multiplied by 0.92, which is 128. And sorry, what happened here? And style will be, I hope you can see the screen share. Style will be this thing. Okay. So buying range, stop loss range, and the selling range. Okay. Now you shortlisted this stock after the filtering because the shortlisting criteria is met. There is a pivot point. There is a cup without the handle. You have the blue shaded area, red shaded area, green shaded area, and point number 6. The filter was the price should be between the pivot point and the 10-week simple moving average. So all the criteria is met. Hopefully the Mark Minervini trend template criteria is also met here. Okay. After you shortlist this stock, next is you do liquidity analysis, comparative analysis, use the data, the filtering criteria. Then you do technical analysis. Technical, not much required because you already have the technical analysis done here. Just check the base count, make sure it is not late stage, and just check whether the relative strength line is at or near the 52-week high, which is the blue dot on the market Smith chart. Check the fundamentals. Does this stock qualify for a positional trade? Then you select the stock and then you check the market condition for position sizing. Okay, let's assume you have done all of that. Let's assume the stock meets our criteria, most of our criteria, and now we have to execute the trade. Let's say we decide that we want to take a 10% position size in this stock when it enters the blue zone. How will you approach this? Well, you wait for the next week. This is a weekly candle, right? You wait for the next week, you observe the volume coming in, you observe the price coming in. If you feel the volume is going to exceed the blue line here on a weekly chart, then it makes sense to take the trade. So let's move it one step forward. So I move it one day forward. See, this is like Monday, right? Look at the volume. Volume is 535K and the average is 959, which means on Monday itself, half the required volume, half the average volume is already taken out, which means on Tuesday, probably the volume will exceed the blue line. So, which means Wednesday, Thursday, Friday, there are 3 more days left, okay, for the volume to continue to trade above the blue line, the 10-week simple moving average. Remember, both the price and the volume moving averages are 10-week simple moving average. Okay. Please understand this discussion very carefully. Now, in this case, the price has entered the stop loss zone. However, there is no need to sell because you never bought the stock in the first place. How? Because the price never entered the blue zone. You will only buy when the price is in the blue zone, right? You might think the stock has already entered the stop loss zone. What's the point of the trade? Well, wait, it's just Monday. You have not yet bought the stock. Okay, you're observing the price, you're observing the volume. So the key observation for you here, if you need to learn how to do this, okay, because there are no rules for this. The key observation is the volume. What's the volume? It's more than 500K on Monday, okay, and then uh, on Tuesday, it is most likely to breach that 10-week simple moving average, right? Which means we have 3 more days. So the volume is most likely to be like 200 or 300 times the average weekly volume, correct? By the time the week closes. So let's move it forward. Now look what happens. This is Tuesday. Look where the volume is. It's coming closer to 976K. Another 200,000 got filled in by Tuesday. Not as expected. We were expecting that on Tuesday the volume might exceed the blue line. But it's coming closer. Maybe on Wednesday the volume will come, correct? And you still haven't bought the stock. The stock has gone 5%. Stock has traded the entire stop loss range. Okay, between 5 and 8%, it has already done that, which is a good sign. Now, if the stock starts to go up, chances are very low that it will come back to that range because it has already traded that range. So that consolidation has already happened. Let's go to Wednesday. See, now the price has entered the blue zone and you see the volume has exceeded the 10-week simple moving average. The average is 1.03 million. See, the average changes because we are changing the day, right? Average changes, but not by a large amount. It changes very slightly because we are changing the day. We are moving forward. But as you can see, visually, you can see the price has exceeded on Wednesday itself, the price has exceeded the average weekly volume, which means you still have Thursday, Friday for a lot of volume to come in. Maybe it might cross 2 million or 2.53 million, right? So it makes sense to take a small position there. Okay. So out of 10%, let's say you might want to put in 5%. So you, out of 100 shares that you plan to buy, you might want to buy 50 shares on Wednesday. Okay. That's how you take a gradual entry. And then next day you see whether volume is picking up, whether the price is trading inside the blue zone. Next, Thursday. See, Thursday actually the price has closed inside the blue zone, which means the price is sustaining. So let's say on Wednesday you bought 50 shares. On Thursday, you might want to buy 30 shares. Remember what Patrick Walker said in his videos? First, he will buy out of 100, he will buy 50 shares, then wait for some time. Maybe the stock would go up 1 or 2%. Then he will buy 30 shares. Then he will wait for some time. Stock goes up another 1 or 2%. He will buy another 20 shares. So that's how he will complete the purchase of the shares, provided the average execution prices remains within that blue shaded area. Okay. So 50 shares on Wednesday, 30 shares on uh, Thursday, and another 20 shares on Friday. So that's how, see, because the price has already exceeded the average week. See where Friday, the candle has closed now. Okay, this is the final weekly candle. I have clicked here 5 times: Monday, Tuesday, Wednesday, Thursday, Friday. So another 20 shares could be bought within that blue zone, correct? Blue shaded area. So that is how you would gradually make your purchases. Remember, the first purchase should be 50%. Next should be subsequently lower, because as the price goes up, okay, your risk is also increasing. So you're buying less and less number of shares. And the reason why you're buying 50% of your planned position size in the first go is because you want to fill a significant part of your position. You want to take that advantage. Okay. And in case if the stock doesn't go up, volume goes up, price starts to go down, you don't buy the remaining 50 shares. Okay. So now your risk is not 5 to 8%. Your risk is 2.5 to 4%. Okay. Because your position size itself is half. So how can your risk be full? Your risk is always going to be half, right? The level of stop loss range does not change, but the amount of risk that you are incurring changes, because your position size itself is half of what you originally planned. Then we will move it forward. This was a good high volume breakout, by the way. Not a breakout, but at least the price moved inside that. Then price continues, then finally breaks the blue zone. Give it some time for it to enter that green selling zone. Fluctuates a lot. This was a scary week, but held its ground. And finally, in this week, so from your position started from November, and within 1, 2, 3, 4, 5, 6, 7, in 7 weeks, so roughly 2 months, you get that return of 20-25%. Fabulous return, right? And the stock came nowhere near your stop loss. And this is multiple weeks, by the way. You just have to sit tight, do nothing. Maybe you want to reduce your position size along the way as the stock reaches here, or as the stock reaches here. You might want to slightly book some profits, take some money off the table. But generally, positional trading is such that as long as the price remains above the 10-week simple moving average, you are doing well. Okay. So that is how you would execute a particular trade on a weekly chart. So there are no rules here. You just have to keep an eye on the volume. You have to keep an eye on the price, and pro rata basis check. You have to extrapolate in the future what the volume is likely to be. Can it cross that blue line? See, here you don't need to go to daily time frame chart to check volume. You don't need to go to 15-minute, 5-minute. We do that on the daily time frame chart, because in daily there is too much volatility. We want to get in and get out quickly if we see weakness. But this is weekly. Okay, this is a weekly time frame chart. There is no need to go on the daily. There is no need to go on the monthly. Just keep an eye on price and volume on the weekly time frame chart, because you're already buying a predefined pattern. You're already buying a proper pivot point. You're already buying a stock which is going up, coming out of the base. So you don't need to micromanage, or you don't need to go to lower time frames to check everything. As long as your filtering, shortlisting, and stock selection is okay, you're putting the odds in your favor. So that is how you would execute a trade. Here you might want to take partial profits. So out of 100, you might want to sell maybe 50 shares, and the remaining 50 you would keep with you as long as the stock remains above the 10-week simple moving average. If the stock closes below the 10-week simple moving average on high volume, then it makes sense to exit the position entirely. But if the stock closes below that blue line, the 10-week simple moving average on low volume, you might want to give the stock some time. Okay. And by the way, when you do partial selling, your stop loss should obviously come at break even, so that on the remaining shares you don't want to lose money. So that is a part of trade management. Okay. And when you buy the shares here on Wednesday for the first time, your stop loss should be at 8%. The hard stop loss should be at 8% below your average execution price. It should not necessarily be the red zone. These zones are drawn based on the pivot point. Okay. This will never change. Okay. The zones will be fixed from one trader to another, but the actual stop loss might differ because your average execution price might be different. Okay. So the actual stop loss that you put in your broking terminal should be 8% below your average execution price. Whereas these bands, these all remain the same. These bands tell you that this is the time to enter, this is the time to take partial profit, this is the time to think about selling. So these bands are very important. Okay. So this will remain fixed. This will not change. You might want to draw some lines on the chart to mark your stop loss so that you can see where your stop loss actually is. But on a weekly chart, even that is not required because the range is very large. On a weekly chart, William O'Neill never put a stop loss because he did not want to show his hand to the brokers. He did not want the brokers to know where he is planning to sell, but he would keep an eye on these bands. Okay. On weekly, you don't see much fluctuation, so you can manage it during the week, the stock, because you have kept quite a lot of mental stop loss distance. So you can just keep an eye on the stock without even keeping the stop loss. But I don't recommend that for beginners. For beginners, you have to keep a hard stop loss so that your loss does not expand. Okay. You bring in that discipline. Once you become experienced, I mean, there is no need, like, even if you don't keep a stop loss, if you have a mental stop loss and you see the price going into that stop loss range, you might begin cutting your position, lightening up on your position, right? So that is how you would approach the trade. Is fairly simple. There's nothing complicated about it. Step one, filtering. Step two, shortlisting. Step three, stock selection using liquidity, comparative, technical, fundamental. And then step four, position sizing using market conditions. Step five is trade execution, which is what we saw here. Step six is risk management, where you keep the stop loss at 8% after you buy. And last step is trade management, where once it enters the green zone, you manage the trade, you lighten up on your position size, or maybe you sell all and come out of the market. It's very simple. Okay. It's nothing complicated. This, I cannot make it more simpler than this. Okay. Just master this. You don't need any indicators here. No Bollinger Bands, no RSI, no stochastics, no ADX, no MACD, nothing, no Ichimoku, nothing, everything, no candlesticks. It's very simple way of trading. The key lies in the three steps: the filtering, shortlisting, stock selection, position sizing. That is where the key lies. Trade management is something that you will learn with experience. Trade execution is something that might not take you to learn more than 2-3 months. In 3 months, you will basically understand trade execution. Trade management is an ongoing learning process. Okay. That is how a typical trade should look like on a weekly chart. And you need to be able to learn how to sit tight. For 7 weeks, you just have to sit there and look at the chart and do nothing. If you can do that, you can become a professional positional stock trader. Okay. I will see you in part number 20. Thank you.